Most people treat their employer retirement plan like a savings account. They put money in and they hope that it grows. But when you understand how these plans actually work, your 401k, 403b becomes one of the most effective wealth building tools you will ever have access to, regardless of what the TikTok influencers are saying. In this video, you're going to get a complete understanding of how your employer-sponsored retirement plan, namely a 401k or 403b, works, the key optimization strategies that can significantly impact your retirement wealth, and a clear action plan for making the most of your employer's sponsored retirement plan. I'm Bob Wolf, certified financial planner and IRS enrolled agent. In this video, you're going to get a complete understanding of how your retirement plan via 401k or 403b works. Before we begin, it's important to note that this content is exclusively educational and should not be misconstrued as specific legal, financial, or tax advice. Let's first start about what a retirement 401k plan actually is, because understanding this foundation changes how we might think about everything else. Here's what most people don't realize. It's not just a retirement account. It's actually a tax control system. A retirement account is an employer-sponsored retirement account that gives you two major advantages: the power to control when and how much you pay in taxes by either shifting them forward or backwards in time, plus potential employer contributions. It's called a 401k because that's the section of the tax code that created it. This means it comes with specific rules that can either make you wealthy or keep you where you are. Now, here's the document that most people never read. It's called the Summary Plan Description, or SPD for short. This is where all of these strategies are hidden in, because your options are only worth and as good as what this description tells us. Your employer is required by federal law to provide you with this document. A lot of the times it will come from HR. It explains everything: eligibility requirements, matching formulas, vesting schedules, loan options, fees, distribution rules. A lot is baked in there. Most people ask HR about their 401k benefits, but they never ask for their summary plan description. That's the mistake. It's also available on the website of the 401k provider under the documents section. Now, first off, most plans require you to be 21 years old with at least 1 year of service, though some employers are more flexible. For 2025, you can contribute up to $23,500 or $31,000 if you're 50 or older. But here's where your summary plan description will tell you what many miss. This money comes directly from your paycheck before you ever see it. This automatic system is actually one of the most powerful features because it removes the temptation to spend that money elsewhere. You're essentially controlling your tax timing without intentionally thinking about it. Now, here's what research shows about participation in retirement plans, and this number will be very surprising. Was to me. According to the latest data, 79% of eligible employees participate in their company's 401k plan. That sounds good until you realize that only 14% are actually maximizing their contributions. But the real problem isn't the contribution amounts. It's what's hidden within that document that may not be uncovered. The opportunity isn't just contributing more, but it's understanding what your specific plan allows that others don't. And one of the biggest opportunities that will be written within this summary plan description is about employer matching, how you can maximize it, and when you actually are entitled to it. And there are 3 common types of matching, and only one of them gives you that instant 100% return. All of the other ones have some level of strings attached. First, a dollar for dollar match up to a certain percentage. If your summary plan description shows a 6% match, they'll contribute $1 for every dollar that you contribute up to 6% of your salary. That's an immediate 100% return on your money, better than any investment you'll ever find, assuming that you immediately vest. And so that's something we'll talk about in a little bit. Second would be a partial match. So your document might show that they match 50% up to 6%, meaning they'll contribute 50 cents for every dollar that you put in up to 6%. That's still a 50% return up to 3%. The last option from matching is simply no match at all. Some employers don't actually offer matching, but the 401k still provides those tax control advantages that we talked about earlier to individuals. Since every dollar that you contribute is your dollar, you don't necessarily need to worry about losing it if you were to change an employer at one point in the future. It's just in a different type of account, which has tax implications, which we'll get into in a little bit. Here's what this might look like in practice on a $75,000 salary. With a 6% full match, you contribute $4,500, they contribute $4,500 for a total of $9,000 contribution going into your 401k or 403b annually. With a 3% partial match, you contribute $4,500, they contribute $22,500, total of $6,750 annually. And with no match, of course, you just put in the $4,500, you're entitled to take that with you in the future, but that's the total amount that's contributed. So one of the most important considerations is making sure that we are getting as much employer match as we are entitled to, since it's essentially free money. But here's something critical that's buried within that summary plan description: vesting schedules. Your contributions are always 100% yours immediately, but your employer contributions might not be. This is where many people get lost. And your summary plan description tells you exactly when you're safe to leave. Your summary plan description will show you whether your plan uses something called graded vesting, where you gradually own more of your employer contributions each year, or cliff vesting, where you own nothing until you've hit a certain milestone. Then you will own 100% of their contributions. Timing your job changes wrong could cost you years of employer contributions. So the takeaway here is that you really should be getting a handle on your summary plan description from your HR and find the vesting schedule section before making any job change decisions or contribution decisions. It might be worth staying a few extra months to become fully vested in thousands of dollars of employer contributions. Speaking of making your money work harder though, there's an even bigger opportunity hiding in your investment choices. And that's what we're covering next. Investment strategy inside your 401k. Here's where most people unknowingly start to sabotage their retirement contributions and investments. They get the employer match right, then they choose investments that slowly might drain their account through fees. Your summary plan description might not actually list every investment option, but if you go on your investment account website, there should be an investment option and fund lineup for you to choose from, and their associated fees. But most people don't start looking at this section, they just look at what the prior performance was, which is a very incomplete way of assessing how we might be allocating our 401k. Some menus are excellent, others are expensive and limited. The excellent ones tend to be with larger employers, the more expensive and limited ones tend to be with smaller employers. What you'll want to look at is the fee disclosure within the investment fund lineup to get a handle on what these fees might look like. There may be some funds that charge close to 1% for the privilege of managing your investments. There are also other funds that may average less than 0.1%. to also help make sure that you're managing one of the only controllables in the investment landscape, which is how much cost you incur on your investments, which is a huge determinant of how our overall balances might change over time. To give you an example of the cost impact, a fund charging 1.5% annually versus charging 0.1% can cost you over $200,000 on a $500,000 balance over a 30-year period. So you are literally paid to be looking at the fees. Common options that are available are something that's called a target date fund, which is something where a fund manager gradually gets more conservative underneath the hood by investing in more bonds and maybe cash or government securities instead of more riskier stocks to have a smoother ride as you get closer towards your target date, which typically has to do with when you might anticipate retiring. This is the easy button and the button that many individuals choose if they don't want to be looking at the nuances of the specific investments within their fund lineup. Another option might be specific funds that are related to different types of vehicles. Maybe this is a large cap United States stock market fund. Everyone seemingly knows what the S&P 500 is since it's plastered all over our news reporting agencies, but that is only accounting for a small subset of the entire investment universe. So it's very important, if you are going to be straying away from a target date fund, that you look deeper into what are all of these funds being invested in. And there is a website called Morningstar, which has a very helpful way to look underneath the hood of these investments, where you can simply type in the ticker symbol and then go to the website where you'll look at portfolio to see what it might be invested in from a geographic and size, as well as how expensive it might be. Now, going back to the S&P 500, that is an index that there are investment funds that try to replicate. These funds simply just try to track what is going on within that index to try to be as closely related to it in its underlying investments. This is passive and cheap. On the other side, you might have actively managed funds which will cost a higher amount, sometimes up to 0.75% or 1 to 2%, and historically don't necessarily outperform index funds over long periods. Ultimately, you're paying for the manager experience within these funds that historically hasn't necessarily meant that you get a higher return. That being said, all investments are different, and you need to really just look into the specifics of each. So going the route away from a target date fund just requires some more due diligence and research on your part. Or if you're working with a third-party advisor, they can help you select what might be most appropriate to you. What many do-it-yourself investors might look towards is putting everything in the S&P 500, but be neglecting international stocks and bonds. So this is something where we may be affording to be a little bit more aggressive in our investing, but when you think about investing overall, you can either be very concentrated and take a lot of risks, which will also get you in a position where you might be losing a lot more in downturns, or you can spread your eggs out over multiple size of companies, different types of companies, and different geographically located companies. A lot of people are favoring the US right now, but that is something that is slowly changing as individuals recognize that even from 2000 to 2010, if you were to be investing in the US stock market, you would be lucky to come away with more dollars than when you initially started. One of the other considerations with having our investments across multiple types of funds is that this allows us to be rebalancing, which will be selling from some funds that are doing well and buying systematically funds that are not doing as well. Essentially, this is forcing us to sell when assets are high and buy when assets are cheap. Now, there's one decision that we'll talk about now that's just as important as your investment choices, and that's whether you choose to pay taxes now or later. And this is where that tax control power really starts to shine. So the question about traditional versus Roth. One of the most common questions I get is whether to use a traditional account or a Roth account. This is where that tax control power that I mentioned earlier becomes your biggest tax advantaged friend. This single decision could cost or save you tens of thousands of dollars in taxes over your lifetime. So let's look at the traditional option. You contribute pre-tax dollars, which reduces your taxable income today, and the money grows tax deferred, and you pay taxes on the withdrawals in retirement. You are shifting taxes from today to the future. And the IRS and taxing authorities also have a hand in the growth in the investment account. The other option is a Roth 401k. You contribute funds that you've already paid taxes on, so no tax break today, but the money grows tax-free, and qualified withdrawals in retirement are completely tax-free, not just on your contributions, but the growth as well. You are paying taxes now to avoid them later. Here's what might help to think about the decision between deciding traditional or a Roth contribution to ensure that you are controlling and making the most of your tax timing power. If you expect to be in a lower tax bracket in retirement than when you are today, traditional may very well make more sense for you. You get the tax deduction now at the higher rate, and you pay lower taxes later at the lower rate. This is a tax arbitrage. You're shifting taxes from expensive years to cheaper years. On the flip side, if you expect to be in the same or a higher tax bracket in retirement, Roth can be more advantageous. You pay taxes now at your current rate and never have to worry about taxes in the future. You're locking in today's rates, and it's a bird in the hand approach. This is something where I have another video talking about traditional versus retirement plan contributions that we might consider, that I'll put a link in the description as well. Now, here's something that your summary plan description will tell you that many people won't. Unlike Roth IRAs, there are no income limits for 401ks. Even if you made $300,000 a year, you can still contribute to a 401k if your plan offers it. Check your summary plan description. High earners have access to tax-free growth that they can't get anywhere else via their Roth 401k. Now, if you're unsure, many plans allow you to split your contributions between traditional and Roth. This gives you tax diversification, some money that's taxable in retirement and some that's not. This is the Humpty Dumpty on the wall approach. You're maintaining maximum tax control flexibility. The bottom line, there's no universally right answer. It depends on your current situation, expected future situation, and your goals. Now, what happens when you change jobs though? That's where most people may end up making bigger mistakes, because this has to do with money in motion events. Anytime that money is transferring hand from one place to another. And it all comes back to understanding your summary plan description. When you change jobs, you'll need to decide what to do with your old 401k. This decision can have long-term implications, so let's walk you through how to be thinking about this. Here's what your description will tell you about your options, and only 3 of them make financial sense. First, leave it with your old employer. This can make sense if your plan has excellent low-cost options that you can't get elsewhere. Your summary plan description will tell you if you're eligible to keep your money after leaving. Typically, if the balance is less than $5,000, you don't have this option. They're forcing you to either roll it to an IRA or a future employer. The second is to roll it over into your new employer's 401k or 403b plan. This helps keep everything consolidated, allows you to continue contributing to the same account, and simplify. Check your new employer's summary plan description to see if they accept rollovers. And third, roll it into an individual retirement account. While this may give you the most investment flexibility since you're not limited to your employer's chosen funds, it may limit you to be doing some things that, if you are a higher earner, may be considering a backdoor Roth IRA contribution, which would be encumbered if you have any sort of IRA dollars. So if you're a high earner, want to get even more money into a Roth account, this should be something that you have on your radar to consider. The fourth option is to cash it out. And please really try not to do this. You'll pay taxes plus a 10% penalty if you're under 59.5, and you'll lose the years of potential compound growth. So you really need to have a good reason to do this. So here's how to decide between the first 3 options. Compare the investment options and fees between your old summary plan description and new one, and the available IRA options. Sometimes old employer plans have institutional class funds with low fees, lower than you might be able to get into an IRA. At other times, the new employer's plan is better. Generally, consolidation makes sense for simplicity. Having multiple 401k accounts scattered across all old employers makes it harder to maintain an overall investment strategy and easier to lose track of these accounts. Remember, those vesting schedules in your summary plan description when timing job changes. If you're close to becoming fully vested in employer contributions, it might be worth staying a bit longer or timing your departure strategically. A few extra months could mean thousands in employer contributions that would otherwise be ripped away from you because they're not vested. There's usually an area on your statement that tells you what's vested and what's not. All right, so to wrap up the specific actions that you can take to make the biggest impact of your employer-sponsored retirement plan, you need to do these in this specific order, and it all starts with that document that most people ignore. First, get your document, the summary plan description, from HR immediately. This is required by federal law, so they must provide it, and it's also available on the document section of the website. Look for the sections on eligibility, matching, vesting, fees, and investment options. Those last 2 might be separate, so there might be a separate document that would be an investment fund lineup that you might need to request. Second, strongly consider contributing at least enough to get your full employer match. Your summary plan description will show you exactly how much this is. This is your highest guaranteed return you'll ever get on your money when there's not a lot of guarantees in the investment world. You're literally turning down free money if you're not doing this. Third, review the investment options and fees using those documents we talked about. Log into your account and look at what you're invested in. If you're paying more than 0.5% in average annual fees, you're probably overpaying. Your summary plan description lists every option, so don't just switch randomly through those options when you have the election period. And fourth, make your traditional versus Roth decision based on your tax control strategy. Remember, this is about controlling when and how much you pay taxes and minimizing our lifetime bill. Your plan description will tell you if you have Roth options available or even after-tax options. And fifth, consider setting up automatic increases. Many plans allow you to set up an automatic increase on your contribution rate by 1% each year. This means you're gradually working towards more contributions while maintaining the tax control without feeling as much of an impact. And sixth, review and rebalance annually. Set a calendar reminder for the same time each year to review your allocation, and if your 401k doesn't allow it, to rebalance if needed. Many 401k plans and 403b plans allow for automatic rebalancing, which is that portfolio hygiene by selling assets when they're doing well and buying assets when they're cheap. This is one of the only free lunches that there is in the investment world to help you get a higher overall after risk adjusted return. Remember, your retirement plan is a long-term wealth building and tax control tool. Don't panic during market downturns. Those are actually opportunities to buy more shares at lower prices through your regular contributions. The power of your retirement plan is not in picking the perfect investments or timing the market. It is in consistent contributions, low fees, tax control through timing, and letting compound growth work over decades. Now, I hope you found this video helpful. If you want more strategies like this delivered straight to your inbox, subscribe to my newsletter for smart money moves delivered regularly on a monthly basis. I share the research-backed financial strategies that actually work, not generic advice that you see everywhere else. You'll get the same insights I share with the families that I work with and strategies that could save you or make you thousands. If this actually helped to clarify your 401k and how it works, how to control the tax timing, make sure to subscribe to the channel. I break down complex financial topics like this every week, always focusing on what the research shows rather than what sounds good and what sounds fancy. And remember, your retirement plan isn't just an account, it's your tax control system. So use it wisely.